I didn't know that until I joined the group, until I got around people that were doing it, that knew more than me. I was willing to learn. I was willing to add value. I was willing to partner. I was willing to do the work. It's a team sport. And until you step onto the field, you're just watching from the sidelines.
All right, guys, welcome to another episode of The Report Saturday edition. And I got my co-host, Mr. Kassidy Warren. Kassidy, what's up, man?
What's up, Rich? Good to be here.
Dude, appreciate you coming back down, man. I feel like you're part of the team now, in and out of the office, hanging. It's cool to always, just rap with you, man. I feel like we have good flow. We have good energy. And I'm a big fan of everything you're doing, man. It's just the beginning.
It's just the beginning, man. I'm stoked to be here. I do feel like a part of the team, man.
You are part of the team.
Everyone's
man.
here.
Doing big things. And everyone's here, the energy, and we're building something cool, man.
Yeah, coming off of that Grant Cardone event, like your team I wasn't here for it, but I knew everything that went into it, and like having people behind you that can like execute on something like that.
Dude, that freaking event was nuts. It was like it all came together in like 24 hours. And shout out to the team, Lauren and Alex Johnson, especially. Literally, like we jumped on a podcast with we actually emailed Grant Cardone, assistant, on Friday night. Like late afternoon, and she's like, hey, can Rich jump on a podcast virtually in 30 minutes? So jumped on, and then Grant's like, hey, I'm doing a tour, Irvine and Carlsbad, for his 10X California tour. I'm like, why are you not coming to San Diego on Saturday? He's like, well, I need a venue. I'm like, dude, I got a venue for you. And so literally just put this thing together, and shout out to Alex and Lauren. They literally just dropped all their weekend plans, poured into this event. We had 350 people show out. And it was sick here in downtown San Diego, Lita, Italy. Sabrina was there. Jared Glant, CEO of Cardone Capital, was there. And it was dope. And you never know what kind of opportunities or doors those type of things are going to lead to. But it was great.
I think if you listen to that podcast again at the end, you didn't have a venue. You didn't have any way of really putting it together, knowing that you could pull it off other than your own confidence. And you told Grant Cardone, we're going to do this. I've got an event for you, or I've got an event space. Let's do this. And you made it happen in less than 24 hours. Like, that's the kind of stuff that people don't realize that you can do, like calling your shot, like taking it and going and doing it. Like, listen to that episode and you'll see like how shit gets done real time.
And I think the takeaway for the listeners, I was telling my team this yesterday morning, on Monday morning, I said, guys, like, when you go and like have an opportunity to network with higher status folks, you literally just got to like seize the opportunity and go all in and make it happen, commit, and you'll figure it out. And that's what we always do.
That's right.
Yep.
That's right.
My man. All right. I am so excited for today's episode. We are going to talk about the 5 expensive mistakes to avoid when buying your first boutique hotel. It's one thing when you guys get in the Airbnb game. It's one thing when you go buy a long-term rental, single family stuff, a small apartment building. But when you get in the boutique hotel game, you start buying commercial real estate, larger assets with more dollars and more zeros and more commas. One mistake could be very, very costly. And so we're going to go over the 5 most expensive mistakes to avoid when buying your first boutique hotel. And make sure you guys stick around to number 5, because 5, I think, in my opinion, is the most important out of all 5 of them. So let's start with number 1. So number 1, buy in markets. And I see this all the time. I see people sizing deals up all the time. I see people talking about boutique hotels all the time. And they're looking in markets where there's a ton of Airbnb saturation. This is the first thing that I avoid. Speak on it, Kassidy.
Yeah. You look at markets like Scottsdale or Nashville or other markets where there's a heavy Airbnb concentration. People already want to go to those markets for Airbnb. There's already other hotels. If you buy a boutique hotel, you're already fighting an uphill battle against the other demand that's in that market. And typically in those markets, the regulations are not as tight, right? So you can have Airbnbs, you can run them, you don't need to live there. Looser regulations, which means there's going to be more Airbnbs and there's going to be less opportunity for demand to be driven to your hotel, versus Airbnb markets or cities that are banning Airbnbs. People won't have that as an option. And so by having regulations on Airbnbs and buying a boutique hotel in that market, you are already driving more demand to your hotel, and you're then only competing with other hotel brands in the market. And so having markets that have stricter Airbnb regulations, where there's permits, where they're banned, where like people have to live in them, you're going to do better by buying a boutique hotel in those markets.
Guys, I own a luxury Airbnb in Scottsdale. It crushes. I never want to own a boutique hotel in Scottsdale because there's 6,000 Airbnbs out there. I don't want to compete with them. Another market that has a ton of Airbnbs here in California, where I see people sizing up hotel deals and I'm like, dude, why are you doing this? This defeats the purpose of investing in boutique hotels. We are taking advantage of the shifting regulatory environment that's going to bring more demand to the hotels. Is Big Bear, California. I don't know how many there are, but I would say there's at least 4,000 Airbnb cabins in Big Bear, California. Why would you want to own a boutique hotel in Big Bear? It makes zero sense. Number two, expensive mistake to avoid is investing only for cash flow. Kassidy, what does this mean?
Yeah, this is something that all beginning investors start investing for is cash flow. They want to quit their job. They want that extra check every month.
Financial freedom.
And I get it. I absolutely get it. But when you do the math on what investing for appreciation and specifically forced appreciation, when you transition from investing from cash flow to investing for wealth, that's what you're doing with boutique hotels. You're looking at deals, you're looking at real estate that is going to have a big hit at the exit, meaning you are forcing appreciation on that property and it's going to be worth 2, 3, 4 times its value. The cash flow is a small fraction of that overall wealth that you're building in a single deal. So when you're looking at hotels, when you're looking at commercial real estate, you are looking at the forced appreciation and the exit value that you're going to get from it, not the cash flow. There is cash flow, but not like you would expect on a bigger deal, or the total value, the total benefit really comes from the refi and the amount of value it's worth at the end of the deal.
Guys, cash flow is great. It creates financial freedom, but true wealth is built from appreciation. And so I always say, in order for me to do a deal, and especially a boutique hotel, but this also applies to residential stuff too, for me to do a deal, I need to buy below market and I need a clear path to force a lot of appreciation. And that is why we love the boutique hotel game versus buying a single family Airbnb, to where you are handcuffed to the ups and the downs of the market appreciation or the market pulling back, which we've seen in the last 30 months now with this high interest rate environment. So guys, buy below market and have a clear path to force a ton of appreciation. NOI divided by cap rate equals value. And so once you guys understand that magic formula, it gives you a lot more reason to go this route, but also gives you a lot more control over the asset, gives you more control over the investment, but most importantly, it gives you the most control over the return profile and how this asset's going to perform for you from a return standpoint. All right, reason number 3, not clearly knowing your exit strategy. What are we talking about here, Kassidy?
Yeah, your exit strategy is basically how you're going to sell the property. And so this could be a new concept for traditional investors or new investors that are used to houses and Airbnbs, because your exit strategy is always, I'm going to go get a realtor, I'm going to go put it on the market, and I'm going to sell it to somebody else that's either buying an Airbnb, buying a long-term rental, or they're just a regular family buying a regular house. When you move into commercial real estate, when you're looking at a boutique hotel, you need to know who you're going to sell this property to. If you don't know who you're selling to at the end of the project, you may not be able to sell this asset. And part of investing is actually being able to sell the assets. It's not holding on to it forever. So your exit strategy is determined by, do you have a restaurant? How many rooms do you have? What's the revenue? Not just like, what's the price that you're looking to get at the end? That has something to do with it. But if you want to go sell to Marriott, if you want to go sell to Hilton, you should probably figure out what hotels Marriott and Hilton are buying. Because if you go redesign and renovate a hotel trying to sell to Marriott, but you do a handful of things wrong, they're not going to want to buy your hotel. Or if you go and try to make like the best hotel ever and you overinvest in amenities in the wrong location, you're not going to get the price that you think, right? So this is what I see a lot of new investors do into the boutique hotel space. They are looking at like a 6 or 12 unit hotel, and they're like, I'm going to add pool, hot tub, sauna. I'm going to spend, $40,000 renovating each room, and it's going to be the best thing ever. And I'm going to get this price for it. In the wrong location, you're going to lose so much money by not knowing who your future buyer is.
Yes, absolutely. And also, I mean, like you said, you could over renovate a property and maybe not command the ADRs that you thought you would. And so there's a lot of different reasons and fundamentals that you have to look at and assumptions to understand your market clearly. But I'll just put it like this. There's a very, very big difference between buying a property just to buy it and have some sort of business plan, but then another investor buying and clearly understanding what the end game is. What is the exit strategy? Who is the ideal buyer for the property? Are you going to exit to a retail investor, maybe a wealthy doctor or an attorney that's just looking to pick up a hotel on the side that's going to be his only real estate investment that he ever owns? Or are you going to look to exit to an institutional group? Institutional group is probably going to want more of a turnkey product and something that is not a heavy lift, right? And maybe you're going to exit to another like savvy operator or a syndicator, and those types of operators probably want some sort of hotel that's going to have some sort of upside. I'll give you an example, and this is more applying to multifamily, but when we sold our 32-unit building in Indianapolis with my old partners, this is back in early 2022, we were going to renovate 100% of the units. And when we found out the property next door was being sold for some crazy number, I talked to the listing broker, and he's like, yeah, we can get you this number, but stop renovating the units. And at that point, we had already renovated half of the units. And at that time in late 2021, with the interest rates at like 2.25% or 2.5%, people were willing to pay more for units that were unrenovated. And so it's all about positioning the product to the next buyer. So in this example, we proved out the rents with the 50% of the units that were renovated. We proved out those rent increases, and then we positioned the sale to the next buyer as, hey, this is a proven net value add. We left you some meat on the bone. All you have to do is go through and finish the rest of the renovated units, and you can capture on the upside. And we ended up getting some crazy number for it. Okay, so that's a perfect example of knowing clearly who the next buyer is going to be.
Yeah, and not being a little delusional about who you're going to sell to. Just because you want to buy this hotel doesn't mean that anyone else is going to want to buy it down the road. You have to understand your exit strategies, who are the buyers are going to be. Another example is the Solvang Hotel. One of our opportunities is selling to a flagged or a soft brand at our exit. And we know that that's possible because there was a Hilton soft brand that came in. They bought a hotel in Solvang. They redid it as, I forget the name of it. But that having an example of a hotel in the area that's already done something like sell to a soft brand or a branded flagged hotel, we now know that that is a potential option for us at exit. And then we should go talk to them about, hey, how did you do this? What were your requirements? How can we sell to you in the future? And I don't think enough people are thinking about that. They get too emotional about what they're buying.
Yeah, absolutely. And then the last thing I'll throw in there is this. You can have multiple exit strategies. So for us here at Summers Capital, we are individually branding each of the hotels in our fund, but they're all operated under the same brand, right? And so now down the road, whether it's 8 years down the road or 10 years down the road, we have the option now to exit each property to individual buyers, or we have the opportunity to package them all up as a portfolio and have a bigger exit to a much larger group that's willing to pay maybe a lower cap rate because they're going to take advantage of economies of scale. So that's one last thing. And then Grant Cardone always says, speaking of Grant Cardone, he always says, the harder it is to buy, the easier it is to sell. The easier it is to buy, the harder it is to sell. If you guys go and find a deal that's been sitting on LoopNet for 365 days that no one wants to buy, well, guess what? It's going to be really, really hard to turn around and sell that asset. But on the flip side, if you go into a competitive market where there's not a lot of saturation and listings just don't sit for very long, and you buy a deal that was competitive that had 10, 15 offers, well, guess what? The second you close, you already have 10 or 15 buyers that are ready to buy your property. If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show. All right, reason number 4. Not doing proper due diligence and not understanding your numbers clearly. What the heck does that mean?
Yeah, so when you are looking at a hotel, there's a different way to evaluate it. And it goes back to what we were talking about with your exit strategy. Like, are you going to refi? Are you going to exit? What's the price that you're looking to get? Because the total dollar amount that you're getting back for you and your investors, the majority of the time is based off of what you're going to be able to sell it for. The cash flow is maybe 20 to 30% of the overall deal. But you need to go in and you need to be able to underwrite, meaning evaluate what you're going to be getting in terms of ADR, occupancy, total revenue. Are you going to be charging any additional fees, pet fees, resort fees? How does that affect your investment returns? what is going to block you from getting those numbers? How much of an investment do you need to make up front to get the actual return that you need? And so the way that I evaluate hotels is I usually reverse engineer the purchase price that I need to buy this thing at. The list price is usually never the price that I'm going to pay for that hotel, right? I need to look at what I'm going to spend on renovations to get the ADR and occupancy to justify the purchase price. And that ADR and occupancy is based off of market data. That ADR and occupancy information is based off of the market data. And then I need to be able to like realistically think, am I going to be able to get this for the hotel? And then what are the other levers that I need to push and pull, right? How long is construction going to take? How many units am I renovating? Am I shutting the whole hotel down? Am I going to do separate buildings at different times? And so as I'm going through the underwriting process, as I'm looking at hotels and running the numbers tell me a story about how I'm going to make this successful. And because I'm taking investor money, it's so much more important that I ensure that this hotel is going to be successful. And so I underwrite everything super conservatively so that when we go in and we exceed expectations, that means we're going to blow the numbers out of the park. Our investors are going to get a huge return.
I love that you said you like to work backwards. I always talk about just simple back of the napkin math. Yes, understand how to do a full underwriting, but like before I even decide if I'm going to put in the time it takes to do a full underwriting, you just do quick, simple back of the napkin math. And you said we work backwards. Okay, what is the exit price you need? So for us, okay, we know what the exit price might be. And then we know on average on a permanent loan or a refinance takeout loan for a stabilized hotel, on average, you're going to get about a 65% LTV. Okay. And so work backwards from there. So, you know, hey, 65% of that ARV or the exit price, that is going to be your all-in cost basis. And then you can work backwards from there. What's the reno? What's the purchase price of the property need to be? Because for me, I think what I consider a good deal would be at the refi, we can pull all our money back out. That's big. We're burring the freaking hotels. And it's basically the BRRRR model on steroids. And if you guys are wondering, what is BRRRR? It's buy, renovate, rent, repeat. What is it?
Refi, repeat. Yep.
Refi, repeat. There you go. And you're essentially pulling all your money out. And so now after the refi event, you have a infinite return on investment moving forward. You can refi and roll those proceeds into another opportunity and then another opportunity. And then the last thing I'll say about this is this. The riskiest part of all these hotel projects is going to be when you're shutting down the hotel to renovate the property, whether you're doing a portion at a time and still having guests stay there so you're receiving some income, but often some of these smaller hotels, you're just shutting down the entire property where there's zero revenue coming in and you still have all your fixed monthly costs that are going out, your property taxes, your insurance, etc., your debt service. And so if you guys don't understand your numbers and you guys don't know exactly how long the renovation is going to take and how much the renovation is going to cost you, then you can easily run out of money, and that is not going to be a good thing, running out of money at any point. You're raising other people's money. You want to be a good custodian of other people's money. I want to sleep good at night. And so understanding your numbers, but also having proper contingency capital set aside. We like to underwrite for 20 to 25% contingency capital. So for example, if the renovation is going to be $2 million, we want to have at least another $400,000 set aside for change orders that are going to pop up in the renovation and also delays in the renovation that are going to go over timeline. So that way, if you need to go over or you have these overages, you have the money sitting there already ready to go to work. And if you don't need the money, great. That's just a win.
That's one of the things that I see happen all the time is people forgetting that they need to raise extra money essentially to cover the construction period. And that one of the biggest levers that you can pull is how quickly you can get your construction done, because then you're going from no revenue and having to raise more money the longer it takes to bringing in money for every room that you bring in service as quickly as possible. The other thing I want to mention about this, knowing your numbers, that I didn't know until we started working together was like debt raise versus equity raise. And usually everyone goes into this saying, I'm going to go raise money, and that means equity. Equity is very expensive to raise. Sometimes on a lot of these deals, it's cheaper to go raise what's called debt. Go raise debt where you basically give people a fixed rate of return. You go raise $1 million and you give them a 15% return. And sometimes that's all they want. That may be cheaper than giving away equity because of the way that you are structuring these deals. So knowing even that little piece So you might be sacrificing on the cash flow to pay that 15%, but you're going to get it on the exit price because you're doing such a good job of improving the property.
Absolutely. And it comes down to cost of capital. Guys, like think about it. If you are bringing in equity, well, you're going to pay 15 to 20% annually for each year that you have limited partners that you're giving equity. And so let's just say you're going to have a 10-year hold and you're going to do 15% average rate of return. That's 150% cost of capital. But let's just say you only really need that money for the renovation period till you can refi the asset. And let's just say that's 2 years. It's much cheaper, guys, to bring in debt and pay 12% for 2 years, which is 24% cost of capital versus 150%. And does not mean that you need to go all in on debt. You could do a hybrid and you could say, hey, we're going to open up 50% towards equity and 50% towards debt. And all that's going to do is juice the returns for your investors and for you as the GP. So understanding the capital stack and clearly understanding the cost of capital is very important, which brings us to number 5, the fifth and probably the most expensive mistake to avoid when buying your first boutique hotel. It's okay to do it solo. There's nothing wrong with doing it solo. If you guys want to go take down your own personal deals solo, I think you should. I encourage it. I do it personally. But if you are taking down larger boutique hotels, I think going at it solo is one of the biggest mistakes that you can make, because I'm telling you guys right now, if you look at the wealthiest human beings in the world right now with the highest net worths, the Elon Musk, the Jeff Bezos, the Mark Cubans, none of these individuals did it solo. None of them.
I think Jeff Bezos only owns 18% of Amazon.
Yes.
Yeah, because what he did, and this is something you guys need to hear, he knows that if he makes other people a lot of money, he will make a lot of money. And so when you bring in the right people, like investors or like an operator, someone to help you along, if you can help other people make a lot of money, you're going to make a lot of money. And so if you're just starting out, especially if you're just starting out, and you're like, should I buy an Airbnb? Should I buy this? Should I buy a boutique hotel? Go buy a boutique hotel, but you just need to surround yourself with the people that know what the hell they're talking about, and will get you there and accelerate your learning that much faster. All this stuff that we're talking about right now, Rich, I knew probably 10% of it less than a year ago, right? And I had done about 20 transactions on the residential side, but underwriting techniques, cost of capital, capital stack, cap rates, exit strategies on commercial real estate on boutique hotels. I didn't know that until I joined the group, until I got around people that were doing it, that knew more than me. I was willing to learn. I was willing to add value. I was willing to partner. I was willing to do the work. It's a team sport. And until you step onto the field, you're just watching from the sidelines, right? So get into the game, get people around you, and then go try to win as hard and as fast as you can.
This game is all about being in the right rooms and surrounding yourself with people that are actually making moves and actually doing the thing that you want to do. I think too often I see people try to get into something new, and it's not just real estate investing. It's not just hotel investing. It could be anything, but they're taking advice from people that have never done it. And sometimes those could be your parents. It could be your personal friend circle. And I'm telling you guys right now, that is the difference between someone winning in this game and never getting started. So that's number 5 things. Just to recap. The 5 most expensive mistakes to avoid. Number 1, buying in markets with ton of Airbnb saturation. Number 2, investing only for cash flow. Guys, cash flow is great. It creates freedom, but true wealth is built through appreciation. Number 3, not clearly knowing your exit strategy and knowing who the ideal next buyer is very important. Number 4, not doing proper due diligence and not clearly understanding your numbers. And number 5, trying to go about it alone. If you guys resonate with this episode and you guys are like, hey, I want to learn more about the hotel investing. I want to learn more about how I can get started this year investing into hotels. Kassidy and I are going to be dropping a 2-day, Saturday, Sunday, boutique hotel investing workshop. It's free Saturday, Sunday, February 8th and February 9th. This coming weekend, you guys got to be there. It's going to be sick. You guys can go to hotelinvesting.com/podcast to register. It's free. Kassidy and I are being ripping. It's going to be sick. And then lastly, another big announcement. As of today, Kassidy is dropping his brand new podcast. I am so excited for this. I'm excited to be a guest. Also, Kassidy, where can the folks find your podcast? Apple, Spotify, all that good stuff.
Yeah, it's called For Your Own Good. It's on Apple. It's on Spotify. I'm going to be dropping 3 episodes a week, hitting it hard. And it's going to be a mix of real estate, finance, but also just incredible stories and people that like found a way to success through their struggles and whatever their story might be. And then I'm going to be doing solo episodes where I'm just trying to spit some fire and inspire the folks out there.
I've seen some of the guests that you're bringing on your podcast already, like already heavy heaters and bangers. One more time, what's the name of it?
For Your Own Good.
For Your Own Good with Kassidy Warren. Go look it up on Apple Podcasts, on Spotify, Google Stitch, all that good stuff. Be sure to check it out. I'm excited to check it out, and I'm excited to be a guest. He's Kassidy Warren. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys in the next one. Peace.